Car payment trap explained. How auto loans destroy your financial freedom. Buying a car is often seen as a symbol of success. People say a car is freedom, it is mobility, it is independence. But what most people do not realize is that auto loans can slowly destroy your financial freedom. In this video, we will explain the car payment trap. We will show how auto loans work. We will explore why they are dangerous for your finances, and we will give strategies to avoid falling into this trap while still getting the car you need. Part 1. The illusion of car ownership. When you see someone driving a new car, you might think they are successful. They look comfortable. They look free. But often, they are trapped in debt. Monthly payments, interest, insurance, and maintenance create financial obligations that are easy to overlook. The idea that a car is freedom is misleading. While it gives mobility, it can reduce financial flexibility. High monthly payments restrict your ability to save, invest, or take risks. Many people do not see the hidden costs until it is too late. The new car feels good. The payment feels manageable. But over time, it adds up. Part 2. How auto loans work. Most people cannot pay for a car in full. They take out an auto loan. Auto loans are essentially short-term personal loans. You borrow money from a bank, credit union, or dealer. You agree to pay it back with interest over months or years. Interest rates can range from 3 to 10% or higher. Loan terms often last 3 to 7 years. Longer terms reduce monthly payments, but increase total interest paid. Some dealers offer low monthly payments, but extend the loan to 7 or even 8 years. This seems affordable at first, but creates a long-term financial burden. Part 3. The depreciation problem. One of the most dangerous aspects of car loans is depreciation. Cars lose value quickly. A new car can lose 20 to 30% of its value in the first year. By year 3 or 4, the car may be worth half of the original price. When you combine high depreciation with high loan balances, you create negative equity. This means you owe more on the car than it is worth. Negative equity can trap people in a cycle of debt. You cannot sell the car without paying extra. You may feel forced to keep making payments on a car that has lost half its value. Part 4. Monthly payment illusion. Monthly payments are misleading. A low monthly payment does not mean the car is affordable. It often means you extended the loan term or financed add-ons like warranties, insurance, and fees. Even a seemingly small payment of $300 a month adds up. Over 5 years, you may pay $18,000 or more. Combine this with insurance, maintenance, and fuel, and the real cost is much higher. Many people do not consider total cost. They only focus on monthly affordability. Part 5. Opportunity cost. Buying a new car with a loan has opportunity costs. The money spent on monthly payments could be invested. Even modest investments can grow significantly over time. For example, $300 per month invested at 6% interest for 10 years grows to over $50,000. Instead, that money is tied up in a depreciating asset. You do not build wealth. You only gain mobility. Part 6. Psychological traps. Auto loans also affect behavior. Many people feel pressure to buy a bigger, fancier car. They justify larger loans because the payment fits their budget. Social pressure and status influence decisions. This psychological trap leads to higher debt, more interest, and longer repayment periods. People trade long-term freedom for short-term status. Part 7. Long-term financial impact. The car payment trap has serious long-term consequences. It reduces your ability to save for emergencies. It limits investments for retirement. It delays milestones like buying a house, starting a business, or traveling. Debt accumulates silently. You may feel financially stable each month, but owe tens of thousands over several years. Interest and negative equity add up, creating financial stress. Part 8. Refinancing and trade-in pitfalls. Some people try to escape by refinancing or trading in the car. Refinancing can reduce monthly payments but extend the loan term, increasing total interest paid. Trading in the car while under negative equity often rolls old debt into the new loan, creating even more financial strain. These strategies rarely solve the underlying problem. They postpone financial consequences rather than eliminating them. Part 9. Insurance and maintenance. A new or financed car requires insurance, often comprehensive and collision coverage. Insurance costs rise with car value. This adds hundreds of dollars per month. Maintenance costs also increase over time. Luxury cars or vehicles with complex systems are more expensive to repair. All these costs combined with a loan payment further reduce financial freedom. Part 10. Alternative strategies. There are smarter ways to get a car without falling into the trap. Strategy 1. Buy used cars. Used cars have already depreciated. You pay less upfront and may avoid loans altogether. Strategy 2. Save and pay cash. If you save for a year or two, you can buy a reliable car without borrowing. No monthly payments means more financial freedom. Strategy 3. Choose shorter loan terms. If you must take a loan, keep it under 3 years. This reduces interest and total cost. Strategy 4. Avoid add-ons. Extended warranties, dealer fees, and insurance add-ons increase debt. Focus on the car itself. Strategy 5. Consider alternatives. Public transportation, car sharing, and biking reduce the need for ownership. This can save thousands each year. Part 11. Understanding true cost. To escape the car payment trap, you must understand total cost. Loan principal plus interest, insurance, maintenance, fuel, depreciation. When you calculate all these factors, you see the real cost is often double or triple the sticker price. This perspective changes decisions. It helps avoid overpaying and prevents long-term debt. Part 12. Budgeting and planning. Financial planning is essential. Decide how much car you can truly afford based on total cost. Set a maximum budget and stick to it. Avoid financing beyond your means. Prioritize financial freedom over status. Monthly payment should be sustainable, but not the only factor. Part 13. Psychological awareness. The car payment trap is not just financial, it is psychological. Advertising, social pressure, and dealer tactics push people to spend more than they can afford. Being aware of these influences reduces impulsive decisions. Part 14. Freedom versus status. The key lesson is understanding freedom versus status. A new luxury car may impress friends, but reduce long-term financial security. A reliable used car may provide mobility without debt, increasing freedom. Financial freedom allows choices. Debt limits options and creates stress. Part 15. Conclusion. The car payment trap is real and powerful. Auto loans, interest, depreciation, insurance, and maintenance combine to create financial strain. Many people underestimate the long-term consequences. Avoiding the trap requires awareness, planning, and discipline. Buy used when possible. Pay cash if you can. Avoid long-term loans. Focus on total cost, not monthly payments. Understand opportunity costs. Financial freedom is more valuable than status. The car you drive should serve your life, not control it. Debt-free mobility provides options. It allows savings, investment, and long-term planning. It prevents stress and increases independence. The car payment trap is avoidable. Smart choices today lead to freedom tomorrow. Think critically about auto loans. Understand the cost. Avoid unnecessary debt, and focus on financial freedom. Remember, a car is a tool, not a status symbol. Use it wisely. Protect your future. Avoid the trap. Financial freedom is the ultimate goal. Auto loans should not steal it. Make conscious choices. Prioritize long-term wealth over short-term image. The car payment trap may seem unavoidable, but with knowledge, discipline, and planning it is completely preventable. Your future self will thank you for avoiding unnecessary debt. Every dollar saved from a loan can be invested in freedom, wealth, and opportunity. The lesson is clear. Avoid the trap, understand true costs, and choose freedom over debt. Your car should serve your life, not your bank account. And escaping the car payment trap is the first step toward real financial independence.
Like the video and share it with someone who needs it.